Hi guys, Mark Lennox here, Alpha Broking. We're just going to go through the buy right option strategy today. We'll get straight into it. Here's the disclaimer. So Alpha only provides general advice only. We don't do any personal financial advice whatsoever. Anything that we speak about today is of a general nature only. We'll go a little bit into the strategies and how they work, but it's a good idea actually to jump on the ASX website. I'll provide some links a little bit later on, but there's an understanding options booklet that the ASX put together, which is also a good one just to start off on. And there's also a fact sheet on the buy right strategy, but I'll give you those links at the end of it. So what is a buy right? A buy right is an options investment strategy in which an investor simultaneously buys shares and writes or sells a call option over an equivalent number of shares in order to generate a premium or income. And what does that basically mean? That basically means if we go out and buy 100 Telstra shares, we want to initiate a buy right, we would be selling the equivalent options contract in order to generate that premium income. Now, according to the ASX, it's the most widely used and basic option strategy. So what is a call option? A call option gives the buyer of the option the right, but not the obligation to buy the trader's shares between now and a specified date in the future at a pre-agreed price. For this right to purchase the shares at a pre-agreed price, called the strike price, the person who buys the call option from the trader will pay a premium to them. Depending on market conditions and sentiment, this premium can vary. In typical market conditions, the premium for an option with a month until expiry generally averages between 1 and 2% per month. At times of peak volatility, as in the last few years during the GFC, premiums of 5 to 7% per month have not been unusual. However, in normal market conditions, between 1 to 2% is generally considered the average. So you might have remembered, some of you, the VIX index went from about an average of 20 up to 90 during the GFC. Now, and options volatility is generally priced using that VIX index. So with a high volatility meant the higher premium incomes for people who were writing options at the time. So as I said, yep, income from the buy right strategy is linked to volatility. So option premium is affected by volatility. Volatility means how quickly share prices are moving up and or down in a short period. In principle, the higher the volatility of the share or the market in general, i.e. the more the share price moves in a day, the higher the premium paid. Conversely, premium goes down if volatility is lower. This is why the income distribution can vary from month to month. Interesting, one of the potential benefits of the strategy can be seen in a falling market. Generally, volatility rises as the market falls, which means that often options premiums can go up. In other words, the investor is paid more. This increase in income can significantly decrease or neutralise a decrease in capital value, and is one of the main reasons the buy right strategy has the potential to outperform conventional investing in the share market. So what that basically means, if you're long a stock, and obviously you're writing options or using a buy right strategy, you're going to be receiving that income as the shares falling. So if you're receiving 1 to 2% a month in normal market conditions, or the volatility is high and you're receiving a little bit more, that's going to offset the depreciation in the share price. And it stands to reason that if you're getting increased income during times of market uncertainty, your capital will potentially go down less or not at all and could recover more quickly. So that basically means that the decrease in your share value is going to be offset by the premium income, and that means that basically if you're holding on to those shares, then obviously you could recover more quickly. So let's go straight into an example. We might do a buy right strategy on BHP. So we're buying 1,000 BHP shares at 45.65 and simultaneously selling 10 $46 May call option contracts in BHP shares. Now the standard contract size per option contract is actually 100 shares. It changed in May of this year, 2011. So for this example, our exposure, if we did the buy right strategy, our exposure is that we need to sell 1,000 BHP shares at that predetermined price, which is $46. So we've written the May $46 call option and received a premium income of $1.04 a share. As the trader wrote 10 call options and one option covers 100 shares, the trader received $1,040 worth of premium income. So that's $1.04 times by the 1,000 shares. We're then obligated to sell those 1,000 shares at $46 any time between selling the option and the option's expiry. So that would be the third Thursday before the last trading Friday of May. If the buyer of the option chooses to exercise their right, the premium the buyer paid for the option at the start of the month is what gives them this right. Even if the shares rise in price to more than $46, the owner of the option can still purchase them from the trader at $46. So in our example, if the BHP share price at the time of expiry was $46 or is above $46, the owner of the option will most certainly elect to exercise their option and purchase the shares from the investor at the prograde price of $46. That means I have to sell my 1,000 BHP shares, which were bought at $45.65, for a prograde price of $46 at the end of May. We'll keep our $1,040 in premium income, along with receiving the capital gain of 35 cents per share, which is a result of the difference between the option contract price or strike price at $46 and our stock entry price at $45.65. Let's say the BHP share price at expiry, so the end of May, is at $46. The person who's bought that contract off us, the options contract, they may choose to do nothing. And basically what will happen if they do nothing, we'll keep our 1,000 BHP shares, and we'll keep the $1,000.40 in premium income. Let's say BHP closes under $46. The owner of the option virtually certain to choose not to exercise and will allow the option to expire worthless. That means we keep our shares, and we keep our premium income, so we can look at writing again, so selling another call option out to June. Or we can hold our shares with the view that the BHP share price might appreciate a little bit, and we can ride a little bit higher a month or so out. It just depends on the situation at the time. And in all those possible scenarios, the investor retains the premium income received for riding the call option. This is what forms the income component of the buy right strategy. At expiry, if the investor still owns the BHP shares, we can choose to ride again in June to generate more income, or we can hold on to them. If the May option was exercised and the investor had to sell the 1,000 BHP shares, then they can choose to repurchase a new parcel of BHP shares and write a June call option and generate further premium income. So our downside really is that we have to sell our shares. It is this regular monthly call writing using the buy right strategy that allows the investor to generate a regular monthly cash income regardless of the share price moving up, down, or remaining flat. So the benefits: no leverage. The buy right does not require leverage or borrowings to perform. No interest payments. With no leverage or borrowings, there are no interest payments, allowing the monthly premiums to be reinvested or used towards funding a lifestyle. So you actually receive the premium up front as well, just to let you know. It's not paid at expiry, it's paid when you write the call option. No negative gearing. With no leverage, borrowing, or interest payments, negative gearing is not a factor. Lower risk. According to research published by the ASX, the buy right is a lower risk strategy than the buy and hold investment strategy, and that is because you're generating those premium incomes to offset the decrease in the share price. Further benefits: liquidity. As the buy right typically is carried out using options with a 4-week expiry, investment capital is only committed 1 month at a time. In the case of an emergency need for funds, an investor can choose to buy back the call option to negate their obligation to sell their shares at a pre-agreed price. Depending on the share price and the time to expire, this must be at a greater price to the original income or premium. Strong cash flow. With the ability to write call options each month, a regular monthly income stream is available to an investor committed to the buy right strategy. Suitable for self-managed super funds because there's no leverage and you're posting stock as collateral. You are indeed allowed to use the buy right strategy in your self-managed super. Now, just a disclaimer there. Obviously, I'm not giving any personal financial advice. We'd suggest that you go away to your financial planner and have a chat to them and just see what the story is with this. But from all the reading and research that I've done, it is suitable for a self-managed super fund. Risk of a buy right. There's only 3 major risks to writing call options on blue chip stocks. The 3 are: we'll start with number 1. At the end of the month, the investor is forced to sell their shares. So obviously that could have tax implications. The call options are exercised. Remember, in return for cash premium from selling the call option, the investor agreed in advance to a price for the shares. So you basically agreed to receive that premium that you're going to sell your shares at a predetermined price. So that's your only real obligation with writing the covered call. So if the underlying share price goes above that agreed and stays there, then the investor will sell the shares. Because basically the person that has bought that call option off you has bought the right to buy your shares at a lower price for the cost of the premium. So they're obviously, if the share price is above where you've written that call option, they're going to want to exercise the call option, pick up the stock at a lower price, and then potentially offload it. Or they might be looking at writing a call option themselves on it. You don't know. But it's okay, because at the end of the day we're still making a profit, which is that premium income. So it's not a bad, it works for you basically. The investor can take the capital, buy some more shares, and repeat the process, or you can go and do whatever you want with them. Number 2, the share goes down in value. If the investor already owns shares, then they have already assumed the risk when they purchase them that the share price would fall. The buy right is no riskier than owning a portfolio of blue chip shares. It is in fact less risky according to the ASX buy right fact sheet, and it offers increased cash flow. Most investors have blue chips in their portfolio, even if it's just in a super fund. So why not put blue chips to work earning an income? And remember that additional income puts an investor in a better position and lowers their risk overall. Number 3, the investor has to sell their shares but misses out on additional upside. Because they have agreed to sell the shares in a grow price, if the market spikes up, the investor will not get that extra capital gain, but it's a small trade-off because he's still receiving that premium income. So you've got to remember, you're giving someone the ability to buy your shares off you at a predetermined price. That's going to put a ceiling, so to speak, on how high the share can go. Or not how high the share can go, but how much you can actually make out of the entire investment. Strategy summary. While the strategy can offer limited protection from a decline in price of the underlying share and limited profit participation with an increase in the share price, it generates an income because the investor keeps the premium received from writing the call. At the same time, the investor enjoys the benefits of the underlying share ownership, such as dividends and voting rights, unless they are assigned an exercise notice on the written call and are obligated to sell their shares. The buy is widely regarded as a conservative strategy because it decreases the risk of share ownership, and that's basically through generating that premium income offsetting the decline in your share value. Important trading points: settlement differences between shares and options. Options actually settle on T+1, so what does that mean? If you did the buy right strategy and you bought Telstra on the 1st of the month, that doesn't actually settle to the 3rd or the 4th, whereas the options are going to settle trade +1, so they'll settle on the Tuesday. So there's going to be a 2 business day period where you're going to have to lodge alternative collateral. Now what does that mean? That means that you're going to have to put up some money to cover the option whilst the share trade is settling with the clearinghouse. Another important trading point: the higher the strike price of the call option, the lower the premium of the option. So obviously the further out you go in terms of price, the lower the premium of the option. So you really want to be sort of, they call it at the money. So if Telstra is trading at say $3, at the money would be an options contract at $3. Out of the money would be an options contract at $3.30. In the money would be an option contract at $2.70. The most time value, and where you're going to get obviously the most premium income, is at the money. But you're also going to be at risk of having to sell your shares at that price because you're obviously giving someone the ability to buy it at where the market is. Quick glossary. So have a quick read there. These will be, there's a bit of an error there. That should be 100, so let's fix that up now. Just have a quick read of those. They're just the different options terms. Probably worth jumping on. We've got some important links here. These are the main ones that you want to have a look at. So you've got the ASX booklet, which will go through the buy right strategy. It's a little fact sheet, which actually explains how the strategy works. Then we've got the ASX booklet, Understanding Options. Anyone who hasn't touched options before, highly recommend that you have a read of that document. It just outlines how they all work. And then you've got the ASX online options course, which will basically run you through the whole lot. As always, if you need any help or anything like that, I'm here to talk, so feel free to shoot me an email, give me a call, and we can arrange a time to have a chat about the strategy. But hopefully after viewing this you can sort of see where the benefits are. Obviously it'll take a bit more education, pardon me, to get you up to the stage where you're comfortable doing it, but I mean that's what I'm here for, so feel free to give me a yell if you've got any questions. Thanks for your time.